In 2024 alone, central banks bought more than 1,000 tons of gold, roughly tens of billions of dollars worth of metal quietly pulled into official reserves. That is not normal portfolio maintenance. And if that pace means anything, it may be the clearest signal yet that the people who run the monetary system are preparing for a world where trust in paper money becomes far more fragile. For years, gold was treated like a relic of the old financial order. It sat in vaults, appeared in reserve reports, and seemed almost symbolic beside the speed and scale of modern digital finance. But behind the scenes, that symbolism has started turning back into strategy. And here's the question almost nobody asks. If gold is no longer supposed to anchor the global system, so then why are the world's most powerful monetary institutions buying it as if it still matters? That is where the story begins. To understand what is happening, you have to step back and look at how the modern monetary system actually works. Most people assume money is backed by something solid, something tangible, something governments cannot simply create more of whenever pressure builds. In reality, the system runs on confidence, debt, and the belief that major currencies will keep their value because the institutions behind them remain credible. That belief became the foundation of global finance after the last formal link between the dollar and gold was broken in 1971. When the United States closed the gold window, foreign governments could no longer exchange dollars for gold. When the world moved decisively into the age of fiat currency. Money was no longer tied to a metal, it was tied to state power, central bank discipline, and market trust. For decades, that system worked well enough to dominate the world. The dollar became the center of trade, debt, commodities, and reserves, while gold became a hedge, important but secondary. Yet every fiat system has a hidden vulnerability. The more debt it creates, the more confidence it must constantly defend. Now look at the last few years. Inflation surged across major economies, interest rates snapped higher, sanctions weaponized reserve assets, deficits widened, and geopolitical rivalry intensified. Suddenly, the old assumption that reserves should sit mostly in foreign government bonds started to look less secure than it once did. Then came the buying. In 2024, the central banks added 1,045 tons of gold, marking the third straight year that official purchases exceeded 1,000 tons, far above the 2010 to 2021 annual average of 473 tons. This was not one country making a political statement, it was a broad pattern across the official sector. Poland added 90 tons, Turkey added 75, India added 73. China reported another 44 tons, even after pausing public updates for part of the year. On a chart, it looks like diversification. On a map, it looks like monetary power quietly repositioning itself. But here is what most people do not realize. Gold buying by central banks is rarely about chasing price. It is about preparing for scenarios that policymakers hope never become public emergencies. When a central bank buys U.S. Treasury bonds, it is holding someone else's liability. When it holds euros, or yen or sterling, it is still holding claims inside a system governed by foreign institutions, foreign politics, and foreign sanctions risk. Gold is different because it is not a promise from another government. It is an asset with no counterparty. That single difference changes everything. In times of stability, yield matters more than gold. In times of stress, survival matters more than yield. And this is where the phrase gold reset starts to make sense. Not as a dramatic overnight return to a 19th century gold standard, and not as a movie-style conspiracy with secret treaties and hidden vaults. The real plan is quieter, slower, and much more sophisticated. Build a reserve structure that can survive a fracture in the existing dollar-based order. Think of it as monetary insurance for a world becoming harder to insure. If trade breaks into blocks, if sanctions expand, if sovereign debt becomes more volatile, or if confidence in major bond markets weakens, countries need a reserve asset that travels across political systems. Gold does that in a way almost nothing else can. What happened next surprised even many seasoned market watchers. Central banks were not just buying gold, some were also increasing attention on where that gold is stored. In 2024, the Reserve Bank of India and the Central Bank of Nigeria disclosed gold repatriation activity, highlighting that location, not just ownership, has become strategically important. That may sound technical, but it matters. Gold held abroad can be counted on a balance sheet, yet gold held at home can feel politically safer in a crisis. If trust in the global system is becoming more conditional, then custody itself becomes part of national security. So what is the real plan? First, reduce dependence on any single reserve currency without provoking a disorderly break from it. Second, hold more neutral collateral that remains valuable across competing political blocs. Third, create optionality, the ability to settle trade, reassure markets, or support a currency if the current system enters a period of deeper instability. This is not about replacing the dollar tomorrow morning. It is about making sure countries are not trapped if tomorrow looks very different from today. And once you see it that way, the gold buying no longer looks nostalgic. It looks pragmatic. Here is the deeper explanation. A reserve system is built on trust, liquidity, and credibility. Governments hold reserves so they can defend their currencies, pay for imports, meet external obligations, and signal financial strength to the world. Traditionally, that meant holding large amounts of highly liquid foreign debt, especially U.S. treasuries. These instruments are easy to buy, easy to sell, and backed by the largest economy on earth. But they are still paper assets within a legal and political framework that can change under pressure. Gold solves a different problem. It does not generate income, but it also does not depend on another government honoring its promise. In a world of inflation shocks, sanctions, and strategic rivalry, that trade-off has started to look much more attractive. But here is the twist. Gold is not only a hedge against inflation or currency debasement, it is also a hedge against the financial plumbing itself. If payment channels become politicized, if reserve assets can be frozen, or if sovereign credit risk starts to matter more than investors assumed, gold becomes one of the few universally recognized forms of final settlement. That helps explain why central banks themselves are increasingly open about its role. In the World Gold Council's 2025 survey, a record 95% of respondents said they expect global official gold reserves to increase over the next 12 months, while 73% said they expect the US dollar's share of reserves to be lower 5 years from now. That is not anti-dollar rhetoric. It is a reserve manager's warning that the world is diversifying for structural reasons. Now go back to history because the pattern is familiar. Monetary systems rarely collapse in a single dramatic moment. They weaken gradually as debts rise, political pressures intensify, and confidence shifts from certainty to management. In the late Bretton Woods era, the problem was simple but dangerous. The world needed more dollars for trade and reserves, but the more dollars the United States supplied, the less credible its gold backing became. Eventually, there were more foreign-held dollars than the United States had gold to cover, and the system broke under its own contradiction. What followed was not monetary chaos, but a reset in rules. Exchange rates floated, fiat currencies expanded, and financial markets became deeper and more complex. The system survived because trust shifted from gold convertibility to the institutional power of the United States and its allies. But every reset creates a future vulnerability. Once money is unconstrained by metal, an debt can grow faster than the discipline required to manage it. That does not immediately destroy a system, but it makes the system more dependent on confidence, especially during inflation, war, or recession. You can see this in almost every major stress episode. During the inflation crises of the 1970s, gold surged because paper credibility weakened. During the global financial crisis, gold rose as faith in banks and balance sheets wobbled. And after sanctions froze parts of sovereign reserves in the modern era, the message to reserve managers was impossible to ignore. Assets inside the system can become political tools. This single realization changed the reserve calculus. It was no longer enough for an asset to be liquid. It also had to be politically resilient. And that is why the current gold accumulation matters far beyond the metal itself. It suggests that central banks are preparing for a more fragmented world, one where reserves are judged not only by return, but by independence. In that world, gold is not a bet against civilization. It is a bet against over-reliance on one architecture of power. So how does this affect the world today? First, it reinforces gold prices by creating steady structural demand from buyers who are not momentum traders and who do not care much about short-term volatility. That means the floor under the market may be stronger than many investors assume. Second, it sends a message to bond markets. If official institutions diversify even slightly away from reserve currencies and toward hard assets, that can influence how global capital is allocated over time. Not overnight, not dramatically, but persistently. Third, it changes how governments think about economic sovereignty. A country with a stronger gold reserve position may feel more secure during currency pressure, sanctions disputes, or trade disruptions. That confidence can alter policy choices long before a crisis becomes visible to the public. And here is where things take a surprising turn. The gold reset is not really about gold alone. It is about trust redistribution. The world may still use dollars for trade, financing, and reserves for years to come. But beneath that surface, more countries appear to be building backup systems, backup assets, and backup assumptions. Gold is the bridge asset in that transition because it can sit between competing blocks without belonging to either one. That does not mean a gold-backed currency is about to appear and replace everything. It means future monetary arrangements may lean more heavily on gold as collateral, as a confidence anchor, or as a neutral reserve asset during periods of negotiation and instability. In other words, gold may not rule the next system, but it could help stabilize the transition into it. What happens next depends on how severe the pressures become. If inflation remains manageable, debt markets remain trusted, and geopolitical tensions cool, gold will still matter, but as insurance more than emergency infrastructure. If those pressures deepen, the metal's role could expand from hedge to cornerstone. Watch the signals, watch reserve reports, repatriation decisions, commodity settlement experiments, and how often policymakers start talking about resilience instead of efficiency. Those words usually appear when institutions are preparing for a world they do not fully trust. So no, the real plan is probably not a secret meeting where governments suddenly announce a new gold standard. It is something more credible and more consequential, a slow reserve migration into assets that can survive a fractured century. And that is why the quiet movement of bullion matters so much. Because when central banks stop treating gold like history, they may be telling you something profound about the future. And as monetary power shifts behind vault doors and balance sheets, the real question is no longer whether a reset is coming, but who will be protected when confidence itself becomes a scarce asset.